Imagine asking a bank for a mortgage. You picture your money waiting inside a giant steel vault, protected behind several tons of metal. That feels intuitive. The banker offers a key, as if your loan will simply unlock cash that another customer carefully saved. That story feels perfectly logical. There is just one tiny problem. The key does not fit, because modern bank lending does not begin by opening the savings vault. Instead, the process begins inside a ledger. The bank approves your mortgage and prepares two connected accounting entries on opposite sides. At first, both columns are empty. No employee removes banknotes, no armored truck arrives, and no savers account is quietly drained. Then, the bank records your promise to repay as an asset and creates a matching deposit that you can actually spend. The loan sits on one side, the deposit sits on the other. Together, they expand the bank's balance sheet by equal amounts. That new deposit can pay a seller, cover rent, buy groceries, or receive a salary transfer. It functions as ordinary money. To understand why, separate money into two layers: central bank money underneath and commercial bank deposit money used by the public above it. Keep them separate. Central bank money includes physical cash and the reserve balances banks use to settle payments with one another behind the scenes. Commercial bank money is the balance displayed in your banking app. Most everyday electronic payments move this second kind of money. That balance is really an IOU from your bank. Regulation and settlement systems make it exchangeable for public money at equal value. Once accepted, bank deposits circulate through markets. Shoppers pay merchants, merchants pay workers, and workers pay other businesses. Commercial banks create much of this deposit money when they issue loans or purchase certain assets from customers. Here's how. Meet Maya. She needs a delivery van for her business, so her application enters the bank's credit approval machine. The van costs $20,000. Maya is not asking for somebody else's envelope of cash. She is asking for bank credit. Credit replaces cash. The bank examines her income, payment history, business prospects, and collateral. It wants evidence that Maya can repay the debt. If the risk looks acceptable, the bank approves her application. One decision now creates two matching entries in its books. The $20,000 loan becomes the bank's asset because Maya owes it money. Her new deposit becomes the bank's liability. Maya receives spendable funds and an equal debt. The bank has created money, but it has not magically created wealth. Maya sends the deposit to the van dealer. Her account falls, the dealer's account rises, and the deposit changes owners. If the dealer uses another bank, Maya's bank settles the payment by transferring central bank reserves through the lower banking layer. This is why out of thin air can mislead. Creating the deposit is simple, but moving it requires real financial plumbing. Banks need reserves, reliable funding, liquid assets, and working payment connections. Every pipe has a cost, limit, or risk. The plumbing costs. Across the system, the deposit still exists. It now belongs to the dealer, while Maya's bank has surrendered reserves to complete payment. Maya's bank may attract deposits, borrow from another institution, sell assets, or obtain reserves against eligible collateral. The machinery also needs willing, qualified borrowers. A bank cannot manufacture good customers merely by switching on a lending machine. A loan to someone who cannot repay is not free profit. It is a future loss moving toward the bank's balance sheet. Now expand Maya's example across a country. Thousands of banks make millions of separate decisions about homes, vehicles, and businesses. Those decisions feed deposit money into one connected economy. No single commercial banker chooses the final national total. Eventually, Maya begins repaying her loan. Her monthly payment enters the same banking system that originally created the deposit. When principal is repaid, Maya's deposit falls and the bank reduces its loan asset. Matching pieces disappear from both sides. Both balances contract. Principal reverses the original money creation. Interest follows another route, becoming revenue that helps cover funding, staff, technology, and losses. New mortgages, business loans, and credit balances add deposit money. Repayments, defaults, and shrinking balance sheets pull it back out. So why can't banks keep pulling the lever and create unlimited deposits? Because the machine is surrounded by hard constraints. Banks must hold capital, a cushion belonging to owners and investors that can absorb losses before those losses reach depositors. They must also survive withdrawals and payments to other banks. A full-looking balance sheet can still fail if liquidity drains away. Central banks influence another major constraint: the price of credit. Higher policy rates usually make borrowing more expensive. But policy is not a master switch. Banks choose whether to lend, and households and companies choose whether to borrow. Ordinary transfers do not create new money. When an employer pays a worker, one account falls while another rises. Only ownership changes. Buying a stock works similarly. The buyer's deposit travels to the seller through financial machinery, but it does not automatically multiply. Credit creation becomes powerful when it feeds asset prices. More loans create more purchasing power for a limited supply. House prices rise, collateral appears safer, and banks may approve still more credit. The machine begins reinforcing its own assumptions. More deposit money now chases the same row of houses. Prices can rise faster than the physical supply beneath them. Except the loop can reverse. Missed payments create losses. Confidence weakens. And yesterday's safe collateral suddenly looks uncertain. Banks protect capital by restricting new loans. Repayment keeps destroying existing money, while fewer fresh deposits replace it. Spending slows, asset prices weaken, and lending tightens again. The mechanism that accelerated the boom can deepen the slowdown. The central bank may lower rates, lend reserves against collateral, or purchase assets to stabilize markets and payment conditions. Policy tools respond. But reserves and customer deposits are not identical. Blue bank-only reserves settle institutions. Green deposits serve households and businesses. Filling the reserve tank does not force cautious banks to approve loans or nervous customers to apply for them. One final constraint holds everything together. Trust that $1 at one bank equals $1 at another. Supervision, capital rules, settlement systems, central bank support, and deposit protection help keep that bridge open during financial stress. Because the bridge holds, a private bank deposit can cross the economy and remain exchangeable at its full stated value. So yes, a bank can create a deposit without first removing cash from a saver's vault. That is the narrow truth. But the phrase hides capital, liquidity, settlement, borrower screening, regulation, interest rates, and the possibility of serious losses. The accounting entry may take seconds. Keeping that promise valuable requires an entire network of banks, markets, regulators, and customers. The real engine is not a pile of banknotes. It is a machine of connected promises, backed by enforceable debts. Borrowers promise banks they will repay. Banks create matching deposits and promise customers those balances will remain spendable. Capital, liquidity, credit risk, and monetary policy surround every new deposit, preventing the machine from expanding without consequences. Modern money is created through credit, constrained by risk, and sustained by trust. The vault was never the true engine. That resolves everything.